Morning, everyone. How you doing today? Really enjoying these live sessions with you. Up than normal for these. I generally think I'm going to do these around 7 a.m. as I'm kind of getting in the groove, as I like to see the market open for a little bit. But today we got a long drive out to Fresno to look at some properties, meet some folks, do all those things. So I wanted to record this a little bit earlier because this is important to me. So got my notes, got my coffee, and we're ready to go. So the first thing that jumped out to me in the review of the news this morning is Uber and their $5.2 billion loss. I just can't fathom that, right? There are some articles out already about, that loss is bigger than all the other companies, put together except a couple last year. And that's just, I just can't fathom a $5 billion loss. And when I see big numbers like that, I have to translate it to normal person numbers. So the first thing I did is I tried to convert that down to more rational number, right? Because I can't compute $5.2 billion. So the first thing I did is I took that, I divided it by 90, right? Kind of think it's a 90-day quarter. And that turns out to be a $57 million loss a day. Every day, Saturday, Sunday included. So that's still too big a number. So I took that down to an hour. So that's roughly $2.4 million an hour, every hour, 24 hours a day. And just for kicks, I took that down to minutes. So they were losing roughly $40,000 a minute for the entire quarter, every minute of every day for 90 days. So that's pretty hard to do. When you see numbers like that, I was an accountant right out of school. So I guess a couple of things jump out at me. First off, I looked at, just like Disney the other day, I was like, okay, is this consumer related, right? Are there rides going down? Is competition going up? Is different ride sharing or these scooters you're seeing everywhere, right? What's really going on in their business? So that's where I go first. And then the other thing that I looked at is I was wondering if this might be what some people in the accounting game call the kitchen sink quarter. Right, so they were going to come in light, right? They were going to miss the number by some small number, right? Since they were already going to miss, and they wanted to be in a better spot going forward. Something they could have thought is, you know what, we're already going to miss, so why don't we just load in everything plus the kitchen sink, pull forward, write-offs we were going to do over time, do accelerated depreciation, whatever that is, right? They got all kinds of levers to pull. And I'm wondering if this might be setting them up for a better future, right? Again, nothing illegal, near as I can tell, but it's certainly a consideration they could have made is, hey, we're going to miss. And oh, by the way, their main competitor, Lyft, had reported a couple of days earlier, and by all accounts had an okay quarter. So they're looking at this going, at the board level going, hey, we're going to miss. They look good. Why don't we just throw it all in, get it all done now? Have the short-term pain, and then we'll be in a better spot going forward. I don't know if that happened. I don't think any of us will ever know if that happened, but you certainly can see the rationale to why that could happen. The other thing that we may not be seeing, because again, this was a phrase that I saw in one of the write-ups, is complicated nature of their financials. That doesn't leave me warm and fuzzy, right? The accounting game should be easy to understand, right? It's not like psychology or these other, creative aspects, right? There's a right and a wrong answer to accounting. So when I see things like their complicated nature of their financials, I get nervous, right? Because I'm a simple human being who's been burned in the stock market before. And, assuming that's true, I've never looked at their financials. But I got to admit, if a Wall Street person is saying complicated nature of their financials, I'd be concerned. So that's kind of the thoughts on Uber. Again, not a stock guy. You should never listen to me for stock advice. I'm trying to share how I interpret daily financial news because I am a real estate investor and what I might see coming out of this. So again, on the Uber side, I think there's two things for me to kind of look at this is, okay, is the growth engine of this kind of tanking? Is it a competitive aspect? Because again, ride share's still out there, so people still need to get around, right? Transportation's not we're not going by Star Trek stuff yet, right? So it still needs to be there. So the other thing is, are they investing in things that we don't see yet, right? Maybe they're buying big tractor trailers and writing them all off this quarter or something. I don't know, but it could be interesting. The other one I caught is the infamous bond inversion, bond yield inversion. And if you don't know what this is, there's probably lots of articles out there, but basically there's been a pretty solid indicator predicting a recession, and that's basically when you're paid more on short-term money versus long-term money. And we're just going to talk about this as rational investors, right? If you were going to give somebody $100 and they were going to give it back to you tomorrow, in most cases you would expect some kind of return, but maybe not a lot, right? So maybe, again, in this example, we'll say $10, right? I give you $100 today, you give me back $110 tomorrow. If I ask for that $100 for 5 years, it's most rational people wouldn't accept the $10, right? Again, this is just an example, right? You would want something more. Maybe it's $10 a year, maybe it's I don't know, right? Whatever it is. But the whole idea is with this inversion is it's flipped for some reason, right? And this is the 2 and 10, so 2-year and 10-year. And what you're basically seeing, or very, very close to seeing, is you will get paid more for 2-year money than 10-year money, right? So that's kind of the problem. I'm live, honey. So this is the thing that is interesting, right? If you're going to have get paid on 2-year money that's more than 10-year money, what does that really mean? Basically, that means we are not as confident about the future. So what that might mean. So that's what that means. So that's coming. They've been a pretty good indicator of predicting a recession, right? It's one of those early indicators. Although I don't see it that way, but again, it's just I look at it as an investor. Oh my God, people are so unconfident about the future that they are going to take higher rates on short-term money. So that's interesting. Goldman Sachs is getting into the Apple Card and giving out subprime loans, which I think is interesting. Not subprime loans, but subprime borrowers, excuse me. And Goldman Sachs is obviously one of the big brokerages in New York. They are probably they serve the richest and most powerful people in the world. And the article I was reading is they are now in charge of saying yes or no to who gets an Apple Card. So to think that they are now saying yes to some subprime folks, I don't think is a red flag. I don't even think it's a yellow flag, really, but I think it's interesting, right? One of the things that if you go back to 2006 through 8 that we paid the price for is lenders were lending to folks that frankly shouldn't have qualified. They were doing liar loans and no incomes and all of those things. And I don't think we're there yet. But everything starts somewhere. And this is one of those interesting things that you go, okay, well, hey, if Goldman's doing this, it's often not the first person, it's often the copycats that come in. So, okay, note to self, Goldman's lending to some subprime borrowers. Who's next? That's what I'll be looking for there. Then we go off to the UK economy. And again, we are a world economy. It's all kind of interrelated. So to see that the UK had a recession, or at least a contraction, right? It's only one quarter, and you need 2 consecutive quarters to call it a recession. A couple of things about it. It was a drop of 0.2%, so certainly a contraction, but not 2%, right? 0.2%. However, when you peel back the numbers, there's a couple of things that I found interesting. One was manufacturing contributed 1.4%. So if you just look at it logically, you take out the manufacturing aspect and the UK economy expanded, right? All else being equal size and all that stuff. But where manufacturing is interesting is that's what's struggling in this trade war environment around the world, right? It's not a US thing. It's not a China thing. It's a world thing. And that's interesting to me, right? Because we're based on consumers. And if manufacturing is falling in other spots, what does that really mean, right? Does this consumer-based economy really slowing a lot more than we expected? Even though we have sub 4% unemployment, right? Is there a big nasty thing coming? It's interesting. And I'm on record saying I didn't get it when the Fed lowered rates. less than a week later, I get it, right? It might be a little scary out there. So that's interesting. And UK has some interesting things, right? They're going through this Brexit thing. They have a leader that's talking about an October 31st deadline that's going to happen regardless, even if all the agreements and trade and stuff aren't out there. Who knows if that's going to happen, right? He could just be setting unrealistic dates to push people to make decisions. It's an interesting negotiation aspect. So that's interesting. And then finally, I wanted to talk about Zillow. And Zillow is obviously Zillow does, lots of real estate investors use it. They traditionally have made their money from ads. I guess it was about 9 months, maybe a year ago, they went into what's called the flipping business, right? They're doing Zillow offers. And on the surface, I'd never done a lot of research. I was like, how does that make sense, right? They're going to lose their butt. It doesn't make sense. Early signs were they were losing money, right? They lost a lot of money on the first sets of properties they've done. I'm actually not as negative after reading a couple of articles. And this is why, again, I'm a numbers guy, right? So it appears that they received 69,000 requests to sell or to buy a home, right? So you go online, you have a home, you want Zillow to buy it, you don't want to list it, don't go on a realtor, don't want to deal with wholesalers or cash buyers, you just go right to Zillow, right? So they had 69,000 of those. And this is where it gets exciting to me. They cherry picked 1,500, right? They closed on 1,500. In rough math, it's about 2.2%. That seems like pretty good cherry picking to me, right? You got to figure half of these 69,000 are complete garbage, right? Meaning the client wants ARV or something higher. But still, to cherry pick 2%, you're going to get pretty good, I think, when you do that long enough, right? You're going to, basically what they're saying is I want the ones with the most juice. And I think that really could turn into a huge thing for Zillow. But this is the one that really got me. Not only can they cherry pick the 1,500, but what they now can do is they could pass off the other 67,500 leads to a real estate agent and get paid a referral fee. Think about that, right? They do all this marketing to rebuy homes. You're on your computer or smartphone, say, buy my home. You want too much money. Zillow says no. Then they pass it off to a local realtor and they make a referral fee. So I think that's pretty genius, right? So they get paid twice. They get paid. They're basically wringing every dollar out of their marketing budget as possible. Last thing I read is they're in 15 markets going to 20. I think I've definitely got to look at Zillow a little bit farther. I still think it's risky when the real estate market kind of rolls over, although they have enough data and enough data scientists, I'm sure, to kind of look at that coming. And again, I'm just enamored that they had 69,000 opportunities to say yes, and they only said yes 1,500 times. And then, oh, by the way, they can still get paid something on the other 67,500. I think that's pretty cool. So I'm going to look into the Zillow thing a little bit more. I'm not a huge fan of all these, we buy now stuff from real estate firms, but maybe I don't get it. Maybe there is really something there. So in the end, that's what I wanted to share with you today. Uber, the bond market, Inversion, Goldman Sachs, the UK economy, and Zillow. So let me know what you think. Go ahead and ask questions, and we'll see you next time. All right, take care.